In this video, we're going to talk about the Roth and specific instances where the account holder thinks it's tax-free and they find out the hard way that not only is it not tax-free, but there are a lot of penalties that they didn't see coming. Coming up next on Holy Schmidt.
Holy Schmidt!
Your Roth IRA is tax-free in retirement, except when it's not. Many retirees spend decades building this tax-free pot of money only to find out the hard way that it is in fact not tax-free to them. There are two rules that can turn part of that Roth into a tax-laden investment filled with penalties, and these rules catch even the smartest of retirees off guard. We're going to talk about what those penalties do and what they don't do to make sure that they don't blindside you. And we're going to use one running example with a woman named Monica. Why Monica? Because I'm a big fan of the TV show Friends. We're going to watch Monica make the same money decisions as thousands of people do every year, and in some of those you're going to see how the trap closes on her. There are 7 things that you need to know about a Roth. Many of them will feel counterintuitive, and one will seem just like a get-out-of-jail-free card that you didn't know you had. And we're going to talk about one here that almost nobody is talking about, and that's the 401k rollover trap. By the end of this video, you'll have a really solid understanding of when your Roth money is truly tax-free and when it's not. Let's set up the scenario. Monica is 62 years old. She retired last year, and she'd been smart about her finances for decades. In 2024, she did a $100,000 Roth conversion from her traditional IRA, paid the tax on it, and felt good about creating a tax-free retirement bucket. Fast forward to 2026, and she needs the cash. Her air conditioner died. Her car needs to be replaced, and her kids are asking for a loan because they need money for something really important. She logs into her online account, her Roth IRA account, and pulls out $40,000, expecting it to be tax-free and penalty-free because, after all, it's a Roth. Then her tax preparer calls her in March of 2027 as he's preparing her tax return and notifies her that she has a 10% penalty, $4,000, on that withdrawal. Now remember, Monica is 62 years old. She's over 59 and a half, and she paid taxes on the money she deposited into her Roth IRA. So how could she get hit with a 10% penalty, an early withdrawal penalty? Welcome to the Roth 5-year rule trap. And here's what makes this even worse. Her tax preparer probably applied the wrong Roth rule before he made the phone call. To understand whether Monica owes a penalty or not, we need to understand a point that catches just about everybody off guard. There isn't one Roth 5-year penalty, there are 2. And they're completely different, and they apply to different buckets of money. And the single most common mistake is applying the wrong rule to the wrong bucket. Here's the foundation. According to IRS publication 590B, every dollar inside a Roth IRA falls into one of 3 buckets: contributions, conversions, and earnings. Contributions are money that you put in directly out of your paycheck. Conversions are money that you move from a traditional IRA or 401k and pay taxes on. Earnings are everything else: the growth, the dividends, the interest. 3 buckets. And what are the 2 rules? Well, the first one is what's called the forever 5-year rule. And this rule simply says that your Roth IRA has to have been open for 5 years in order for you to take the funds out tax-free. The clock starts on January 1st of the first year that you opened your Roth, and once you reach the 5-year mark, you have satisfied this requirement, and you'll never have to worry about the 5-year rule again. So if you opened a Roth IRA in 2010, you put $50 in that Roth, and then you closed it in 2015, and then you opened another Roth IRA later, you don't need to wait another 5 years because you've already satisfied the 5-year rule. The 5 years is forever. Once you've satisfied it, you can apply it to future Roth IRAs. But it's important to note that the one-time nature of this rule applies to the earnings bucket only. Rule number 2 is the 5-year conversion rule, and the 5-year rule applies to every single conversion, not just the first one. If Monica did a conversion in 2024 and another one in 2025, those are 2 separate conversions with 2 separate 5-year periods. The 2024 conversion is fully aged by January 1st, 2029, and the 2025 conversion is fully aged by January 1st, 2030. They run side by side. And here's the rule that ties this all together. The forever rule applies to the earnings bucket. The conversion rule applies to the conversion bucket. Contributions can come out tax-free, penalty-free, no questions asked. In other words, that was always your money. Those contributions were taxed before you put them into the Roth, and the IRS doesn't get a second bite at those dollars. Apply the wrong rule to the wrong bucket, and you either think you owe tax when you don't, or you don't think you owe tax when you do. And that's what happened to Monica's tax preparer. Next, we're going to talk about one of the most counterintuitive things in this whole discussion, and that's what I call the 59.5-year escape hatch. And that, simply put, is once you reach age 59.5, you won't be faced with penalties. The conversion 5-year rule is built around a 10% penalty for early withdrawal. Once you're over 59.5, the 10% early withdrawal penalty tied to Roth conversion timing generally no longer applies. The IRS publication 590B spelled it out in plain English. Once you are 59.5, the conversion 5-year clock no longer threatens you with a penalty. Now, to be super clear, this is huge for this audience because a large portion of the people watching this video are either approaching 59.5 or over 59.5. So now back to Monica. She did the $100,000 conversion in 2024. She withdrew $40,000 in 2026. Does she have a penalty on that withdrawal? Well, the answer is no. Because she's over 59.5, the 10% penalty can't be applied no matter how recent it was. Now, if the $40,000 that Monica withdrew was earnings instead of conversion dollars, she might still owe tax on it because of the forever 5-year rule. But the 10% penalty, gone. And most people don't even know that escape hatch exists. Here's why this is important. If you're, say, 60 years old today and you want to do a Roth conversion, you don't need to wait 5 years to access that conversion penalty-free. You only need to worry about the tax side because the penalty side is no longer there because of your age. And this changes the math completely for retirees. Speaking of Roth conversions, a Roth conversion is not a yes or no decision. It's a timing decision. Bolden's Roth Conversion Explorer analyzes your income, taxes, and future RMDs year by year, and then runs multiple scenarios to help you optimize when or if converting actually makes sense. Bolden is one of only 3 affiliates we have on this channel, and it's the personal financial planning software that I personally use. If you'd like to try Bolden free for 2 weeks, you can use our affiliate code. Simply go to go.bolden.com/Schmidt and you can get your 2-week free trial of their full-featured software. After that, it's just $12 a month paid annually if you decide to keep it. The next point is what's called the withdrawal ordering rule. And there's one thing that the IRS does, it actually protects you more than if this rule didn't exist. When you take money out of a Roth, the IRS forces the withdrawal to come out in a specific order. Contributions first, then conversions, oldest conversion first. According to IRS publication 590B, you cannot designate which bucket your withdrawal comes from. The IRS does it for you in this exact order. The ordering rule is extremely protective for retirees. Why? Because contributions come out first, and contributions aren't subject to either 5-year rule. So if you made $30,000 of direct Roth contributions over the years and you take out $20,000, that $20,000 is treated as contributions coming out. Tax-free, penalty-free, no 5-year rule to worry about at all. Let me put real numbers on this with Monica. Now let's assume before her $100,000 conversion, she was making contributions to her Roth. Let's assume it was $5,000 a year from 2014 to 2023. That's $50,000 worth of contributions to the Roth. So she has $50,000 in the contributions bucket, $100,000 in the conversion bucket, and let's assume that she has $25,000 of earnings, of growth inside the Roth. When Monica withdraws $40,000 in 2026, up to $50,000 of withdrawals are treated as contribution withdrawals. No tax, no penalty, none. And here's the interesting part. Even if Monica was 35 years old when she made that withdrawal, she would not owe anything on that withdrawal. It would simply be treated as contributions coming back. This is why retirees who've been contributing to a Roth for years have an enormous safety cushion built in. The 5-year rules generally don't bite until you've burned through all your contributions and started touching the conversion or earnings buckets. Now let's talk about the 401k rollover restart trap. That's a mouthful. Let's say you've been contributing to a Roth 401k at your work for years, for 15 years. You roll your Roth 401k into a brand new Roth IRA you just opened. You assume the 15 years of holding period in the Roth 401k carries over. It does not. According to the IRS, the holding period of your Roth 401k goes back to 0 when you transfer it to a Roth IRA, if it's a brand new Roth IRA, and you have a 5-year period. So you could have a 15-year history in your Roth 401k, roll it to a brand new Roth IRA, and have a 5-year clock that starts ticking on the earnings in your Roth IRA. There is a saving grace, and this has saved a lot of people. If you had a previous Roth IRA that was open for 5 years or longer, even if it had just $100 in it, even if it's closed, the 5-year window has been satisfied. This is the single most important planning move in this entire topic. If you have a Roth 401k at work and you've never had a Roth IRA, now would be a good time to open a Roth IRA, even if you put $100 in it, because that starts the clock. And that single action starts the forever 5-year clock for every Roth IRA you'll ever own. And if 5 years from now or later you roll that Roth 401k into a Roth IRA, you won't have to contend with that 5-year window. It will be eligible for tax-free treatment immediately. On the flip side, if you find yourself in your mid-60s and you have, say, a $400,000 Roth 401k and you decide to roll it into a Roth IRA, which a lot of people in their mid-60s do, that's a brand new Roth IRA. You'll be watching the earnings on it grow tax-deferred, but you won't be able to withdraw any of the earnings tax-free for 5 more years. That's a real problem for a lot of people, and it can be avoided simply by depositing $100 into a Roth IRA. Now we're going to talk about the inherited Roth IRA, because there's a different twist if you inherit a Roth IRA. This one really matters. Think about surviving spouses, children, beneficiaries. The rule is simple. The 5-year rule doesn't stop once the original account holder passes. The 5-year rule follows the account. According to the IRS, when a beneficiary inherits a Roth IRA, the original owner's 5-year clock carries over. So if the deceased had only opened the Roth 3 years before they died, the beneficiary still has to wait 2 more years for the forever rule to be satisfied before withdrawing any of the earnings tax-free. This catches surviving spouses and children completely off guard because they inherit the Roth thinking that it's a tax-free instrument, and it's not tax-free yet. And unfortunately, the nature of inheritances is that a lot of people, when they get an inheritance, stats show, particularly if they don't need the money, that they spend the money very aggressively. Happens all the time. And what they'll find is if they do it inside of the 5-year rule, they're going to owe the IRS some money. There's also a separate rule called the 10-year rule. According to the Secure Act, most non-spouse beneficiaries who inherit a Roth IRA after 2019 must fully empty that IRA within 10 years. That's 10 years from the original owner's date of death. The good news is that there isn't a 10% penalty on an inherited Roth IRA regardless of the beneficiary's age. The bad news, if the deceased hadn't held the account for 5 years, the earnings in that account can still be taxed until the 5-year clock runs out. Surviving spouses have additional options. They can either treat the Roth as their own and it becomes part of their own Roth requirements, or they can keep it as an inherited Roth IRA and use the deceased's clock, but limit future contributions. For most people, the first option is cleaner. The bottom line for Monica is she probably owes nothing. Her tax preparer needs to revisit Form 8606 and fill it out correctly. Now, here are 3 specific actions you can take this week. First, if you participate in your company's 401k plan and you use the Roth option in that plan and you've never opened a Roth IRA, open a Roth IRA today, even if you put $100 into it. You can do this online in 10 minutes at any one of the major brokerage firms, and once you put the money in, your forever 5-year clock starts ticking down. And importantly, it protects you from the 401k rollover restart trap that we talked about earlier. This may be the highest impact, low cost, low time contribution moves you can make this week. Second, if you're considering a Roth conversion or you have done a Roth conversion, make sure you keep written records. Believe it or not, a lot of retirees don't keep written records. They just assume it's all out there somewhere. Even though Form 8606 is designed to track it, the brokerage firms are not required to track it on your behalf. The Roth IRA is one of the best retirement vehicles in the entire tax code. Tax-free growth, tax-free withdrawals, and no required minimum distributions. But these benefits are only fully unlocked when you understand which rules apply to which buckets. Apply the right rule to the right bucket, and your Roth is exactly what it was designed to be: a tax-free, penalty-free way to build great wealth. If you apply the rule the wrong way, you either pay taxes you don't owe, or you skip planning that would have saved you thousands of dollars. If you like this video, check out that video, The Average Net Worth of a 60-Year-Old in 2026. Also, don't forget to check out Bolden and get your 2 weeks free. Simply go to go.bolden.com/Schmidt, and you can try it free for 2 weeks. After that, it's just $12 a month paid annually if you'd like to keep it. This is Geoff Schmidt, and I will see you in that video right there.